Hello and welcome to your quarterly wrap-up and technical outlook for global markets at the end of quarter 2 2023. Normal disclaimers apply, of course, and before we get started, I love this quote from Ed Sikota, who says, "The trend is your friend, except at the end where it bends." And as you'll see, we're in a very trending market at the moment, so the trend is our friend. And if you haven't tracked it down, I'd recommend having a look at the Whipsaw song on YouTube by Ed Sikota. Very amusing. But enough of that frivolity, let's get into the markets, and kicking off with the S&P 500 on the monthly chart, and I've put it on a log scale this time just to illustrate how clear that uptrend is. The surprises have almost always been to the upside since the bottom in 2009, and you can see that the pullbacks, even that 2020 pullback, seemed like just a blip now, and once again we see the market surprising to the upside, right bang in the middle of the trend. On the weekly chart, we can see that a little bit clearer here, that corrective pullback that we saw through most of 2022 was broken at the early part of 2023, retested the top of the trend line, and now it's off to the races once again. And on the Ichimoku chart, we can see that we've broken through the cloud to the upside, so we're now confirmed bullish, and the downside support where the cloud is currently situated is around about that 3900 to 4050. On the market fundamentals, firstly looking at the market breadth for the bullish percent index on the S&P 500, and you can see that here we've only got about 62% of stocks bullish, and yet we're seeing this leg up in the trend once again to the upside. So that does seem a bit of an anemic number on the face of it, and we'll have a dig into why that is the reason in a second. But before that, we'll just have a look at the stocks above their 200-day moving average. And once again, we can see it's a very sort of middling number here, only 59% of stocks above their 200-day moving average, and yet we're seeing this uptrend develop in the market. So what's going on here? Well, the main reason is this is a distribution of the returns for all the S&P 500 stocks, and you can see the median sits at about 0. So about half the stocks have made a loss this year, about half have made a profit, and yet this was about a month ago. The S&P was up about 8%. And I think you can see the reason here is because we've got this huge right tail here of a small number of stocks making huge gains, and sort of many other stocks doing very not very well or not very bad, and then a small number of stocks doing bad, but not as bad as the stocks that are doing well are doing well. So that's pulling the whole index up. Hence we have this narrow market breadth, and the drivers of the returns in the index are a very small number of stocks. And I think you can guess the ones that we're talking about. It's these mega cap tech stocks. The top 5 of the S&P 500 returns come from make up 56% of the returns this year, and the S&P 500 as a whole at that point was only about 8%. So you can see here the 5: Apple up 36, Microsoft, Alphabet, Amazon, and Nvidia, which is the latest member of the gang, is up a whopping 159%. They keep coming up with different acronyms. They've been FANG stocks, FAMG stocks, Magma stocks. It looks like they're going to have to come up with another acronym now. Nvidia has joined the pack as well. But nevertheless, the market is rising, and obviously this is off the back of the big sort of AI trend that's in the market at the moment. And the market is rising. So I guess what we have to do as analysts is to dig a bit deeper and find out if this rise in the market that we're seeing is or has a sound basis. So one item we can turn to is the discretionary versus the staples. This tends to be a bellwether of the market and indeed a leading indicator. And you can see here it has actually ticked up. Unusual, you would think, when there's a cost of living crisis going on, but there is that move back towards discretionary spending, and that's turning this around, and that's giving us a good sign that both of these are moving in the same direction. There's no divergence here, so that's reassuring. The other one is the semiconductors versus the S&P, and you might it might not be too much of a surprise that these are streaking ahead, given the tech stocks, particularly companies like Nvidia, doing very well. They're churning out gear to take advantage of this AI revolution, and all of those things need semiconductors. So these are also doing very well, and again, that's gives us confidence that this latest uptick in the market may actually continue. The advanced decline line also has ticked back up. It's now making higher highs and higher lows once again, and that's a good sign, because once again it agrees with the market going up as well. This relative performance chart kind of illustrates quite nicely the difference or the schizophrenic nature of the market, if you like. The Nasdaq 100 index, which is very tech heavy, it certainly has all those mega cap tech stocks in it, and lots of other ones which are also up and coming in terms of the AI revolution, is up about 36% this year. S&P is currently up about 14, and the Russell, which is the small caps, is only up about 6. So this is what's driving the whole market, is these big tech stocks, and the general move. It's another sort of echo of the internet boom that we saw back in the late 90s for sure. But while that's all going on, we've also got this very steep inversion in the yield curve, where we have the short-term cash rates. This is in the US. The Fed are raising rates. They're now up above 5% on the cash rate, but the long-term yield on bonds is staying very sticky. So you have this rising of the short end of the yield curve and causing this huge inversion. So why is that important? Well, because inversions in the yield curve have historically been very good leading indicators of recessions, and you can see this is the spread between the 10-year and the 3-year. So the bottom part of that curve, so this part of the curve here. So that the more that part steepens, the higher that this chart will go. And you can see where we are now. We haven't been up in this area since the 1980s, really. And you can see these gray bars here show the recessions, and you can see almost every time there's been an inversion, when it's popped up above the zero line, that we have had a inversion. So you would think that this where we are now would give us a very good clue that there's a high probability of a recession coming. And if we look at the probability, that is indeed the case. In fact, there's a 71% chance of a recession in the US within the next 12 months. So what does that mean for the markets? Well, if we look at what happens to the stock market when there's an inversion in play, which are these red areas on the chart, you can see that the market sometimes goes up, the market sometimes goes down while the inversion is on. So there's no real clue about what we should do with that information in the short term. But what is also clear from this chart is that when these recessions happen, these gray bars, that it almost always means a pullback in the market itself. Unfortunately, we don't know we're in a recession until 2 quarters have passed. So again, it's not a great timing tool, but it also means it's no cause to sell the market just right at the minute. And on the sentiment indicator, we can see that there is no rush to the exits at this point, and there's certainly no over exuberance, if you like, on the bullish side. We're very much middle of the road in terms of the put-call ratio. So it's looks like it's steady as she goes at this point. And the VIX is kind of also telling us that as well. It's down. We haven't seen a print this low for a long time, down around this 13 area. So it's showing very, very low risk in terms of the VIX. And that usually means the market rises when there's not a lot of fear around. So how low is low on the VIX index? Well, if we look at a sort of long-term chart, this one goes back to 1990, you can see that we're still above the historic lows. It can get down below 10 in unusual circumstances. But the one thing to remember is that the VIX, as you can see, is very much a mean reverting index. So when it gets to these very low periods, then usually the next move is up. and inversely, when it gets to these very high areas, its next move is down, and obviously a move up in the VIX tends to be a move down in the market. So there's still some room to go should the VIX want to go down, but I also wouldn't discount a corrective move along the way, because it's starting to look a little bit oversold, if you like. On the seasonality here, we can see the S&P 500 to date is actually following the seasonality very nicely. So we had this sort of period, January, February, tending to be quite choppy, and that's indeed what we saw. And then we've got this move up between March and June. And again, we've also seen that in the market. What happens after that? Well, we tend to go into these northern summer doldrums where a lot of the traders go on vacation and nothing much happens in the market, and then they all come back in September and you know, the party starts again. So we'll see if that plays out this time. We're obviously in a little bit more of an unusual space at the moment with all this AI froth going on at the moment. So we'll see if that manages to push the market higher, or whether we do tend to more follow this seasonality picture a little bit more. And the pre-election year on the presidential cycle shows us this rising, very much a rising trend on the blue line here. But in terms of the Dow, it hasn't been a great match for it. Now, the Dow is the input the input series for this averaging that we're seeing on this presidential cycle chart, but the Dow, there's only two of those mega cap tech stocks, which is Apple and Microsoft, which are in the Dow at the moment. So it's clearly not getting the advantage of the Nasdaq or the S&P 500 are getting from having the rest of those big mega caps in there. So that could be one reason why it's looking fairly sideways at the moment. So we'll have to see if it starts playing catch up, but it's at the moment it's not a great match for the cycle. Looking at Calvert's pressure chart for this year, we can see that the best of the months are now behind us. 3, 4, and 5 were looking like they were going to be the best, and that's certainly what we've seen. And then again, we come into this kind of choppy, summery, northern summer doldrums area right up until November by this forecast here. So we'll see how that plays out. August looking like a little bit of an outlier, which may cause a little bit of a fillip in the market, but in terms of the best of the rate of change in the market, that looks like it's behind us now for this year. On the decade cycle, just looking at the price averaging, we're here in 3. It does look like we're kind of seeing what we would expect, which is that sort of move up at the start of year 3 and turning more sideways towards the end of the year, but then moving up in towards year 4. That would be 2024 for us. And if we look at Calvert's decade pressure chart, we can see that 3 is one of the better years in terms of its rate of change, moving into 4 and 5 and 6, all looking fairly positive, and 5 especially positive. So let's see how that plays out as we get there. Switching to the Australian stock market now, and it's very much sideways for the old XJO at the moment. It's not doing a lot, as you can see. It's stuck between the 6850, which is the old 2007 high, and the high is it printed in the last couple of years, which is 7600. So very much sideways, but reassuringly close to the high. So it looks like it's sort of coiling up to make a little bit of a breakout, but 6850 and 7600 are obviously the key levels at the moment. On the weekly chart, you can see that a little bit clearer here. It's very much stuck here. Every time it gets to one or other of those extremes, it tends to bounce back, and we're stuck right in the middle of the range at the moment, around about 7200. On the cloud, though, we've kind of bounced back up and over the cloud, so we are in bullish territory technically, but you know, as the market turns more sideways, these Ichimoku charts become a bit less reliable in all the chop. But you can see the cloud support down there is 7,000 to 7,100. So we'll see if when the cloud gets thin, it doesn't offer as much support as when it's nice and thick, as you can see back here. But nevertheless, we'll keep an eye on this one. And looking at how the ASX 200 compares with its brethren, you can see that the Nikkei is actually the one that's storming ahead up here, about 27% return for the year. S&P, as we know, is about 14. The Shanghai Composite down about 2%, and the XJO also around about that 2%. And the Hang Seng is bringing up the rear, actually making a loss this year, down about minus 5%. Interesting to sometimes look at the ratio of the ASX 200 to the S&P 500, and you can see here how when the S&P was pulling back through 2022, how the XJO relatively was powering ahead. However, as the reverse has now happened and the S&P is trending up, but the XJO has gone more sideways, you can see that ratio starting to fall once again. On to the currencies now, and the US dollar is kind of just wavering around this 104 area. Looks like, you know, the surprise might be to the upside. It's just gathering a little bit of steam at the moment. The interest rate differentials are definitely in the favor of the US dollar at the moment, so we would expect the upside to win out. But, you know, about 101, I would say, it's not drawn in here, but about 101, I would say, would be the key level on the downside. If it breaks that, then we'd probably be back into the range again. And the Aussie dollar attempted to get above that 70 cents area, but once again fell back. There's an expectation that we may be at or near the top of our interest rate curve at the moment, so that's that the FX traders are obviously detecting that as well, and selling the Aussie down. So it's back in the middle of this range between 60 and 70 here. The last low was about 62, so that would be the first key level, and then back at 60 for the next one. On the euro, it's bounced back up above this 105 level and just seems to be holding there at the moment. And it's this kind of downtrend line here has kind of been broken in a few places so far, so it's probably not very active at the moment. But that 105 continues to be the key level for the euro on the downside. On the British pound, also trapped below this trend line that's been in place since 2007, really, just bouncing around at that 126. So the key level for this market would be that 130-ish, where the trend line is, or 119. Well, it's actually 120 almost, where the downside support is acting. So it will have to break one way or another. But for the moment, it looks like the upside is the way it's maneuvering. And the Japanese yen, well, I mean, this chart is just a poster boy for interest rate differential. The Japanese interest rates are negative still at the moment, have been for quite a while. And, you know, if you can get 5% on your US dollar and you can get negative interest rates on your yen, well, which way is the market going to go? It can only go one way, which is down, as you can see. And it never even attempted to bother this 0.008 area. It's just fallen away again, and now looks like to be heading back for the old lows there, down at 0.006 of a yen to the dollar. On Bitcoin, well, after this huge pullback from 69,000 all the way back to 15,000, we're now up 100%. So you can't say the Bitcoin doesn't produce action. So back in the middle of the range, obviously, but it does look, you can see these big green candles on the weekly chart here pushing to the upside. So it does look like there are legs behind this. And, you know, the so-called crypto winter that we've been in since this fall back here in 2022 looks like it may be about to be over. We can maybe just detect a little bit of an inverse head and shoulders in there. So we'll see where this goes next, but there's obviously a lot of resistance going to be up in this area when it gets to the sort of high 30s, and we'll see where that takes us from then, but looking bullish for Bitcoin. On the commodities, crude oil has been selling down. The inflation risk tends to be abating now. That's having a negative impact on the price of energy and crude oil in particular here. You can see it's heading back for this 63. In fact, it's already had a test of that area there. 130 looks like a sort of distant dream at the moment to get back up to that level. But this is obviously good if you're a consumer of energy. And 63, the key level for crude oil. Soybeans, we don't often look at soybeans, but I thought I'd stick it up just to as a proxy for the rest of the agriculturals, because they also tend to be coming off at the moment as that inflation risk tends to recede. Didn't quite get over this 1800 level. That was the key level from back here in 2012, but now just seems to be selling down back into the middle of the pattern once again. And on gold, well, we're still stuck in this range between about 2080 and about 1620. You could argue that we've seen now a triple top here, but until there's a breakout one way or other of these zones, it's very much sideways for gold. One bullish case you could make is that it's holding near its highs. It came into the pattern from the downside up, so usually the next move, or there's a higher probability, I should say, the next move will be higher than lower. On the copper, well, it is also failed at this $465 to the pound up here, and it's now falling once again back into the pattern. Looks like this is a failed swing high at this point, and copper looks like it is getting cheaper. And finishing off on the iron ore, well, it's stuck in this range between about 80 and 130. 130 has been a key level in the past, came back up, just touched there in March, couldn't quite get over that level, and has sold off once again. It's not clear which way the next move is going to be from here, so I guess the best you can say is sideways for iron ore. So just to wrap that up, the US stock market certainly looking bullish, especially those top 5 mega cap tech stocks. And the Aussie 200, well, pretty much consolidating next to the high. Unfortunately, the Aussie 200 doesn't have any of those mega cap tech stocks, so there's nothing dragging it up like there is for the S&P 500. On the currencies, US dollar strength as that interest rate differential weakens the currencies elsewhere. And on the commodities, oil looks like it's weakening, and most of the other things seem to be range bound or falling. If you want to have a look at some of the strategies that I trade, you can find them on smartsystematictrading.com. These are a couple of examples. ASX rotational stock trading. This one's an ETF mean revert strategy. Trades at about 90% win rate. Doesn't trade often, but it's a very nice one to have in the kit bag. And with that, I will thank you very much for your attention. Wish you good luck, good trading for the next quarter, and I will see you at the end of September. Bye for now.